Hello and welcome, TradingView community. My name is Tyler Wood. I'm a CMT charter holder, and I'm joined today by Alex Cole, the co-founder of GoNoGo Charts. How are you doing today, my friend?
I'm doing well, thanks. Ready to go.
Awesome. This is going to be a multiple part educational series where we're going to talk about general technical analysis and also the GoNoGo Charts tools. Now, one of the points that we drive home here at GoNoGo Charts all the time is that we need a repeatable process. Now, think about how you felt at the end of 2021, SPACs, meme stocks, crypto craze. It was a bullish market and very, very frothy. Did you feel differently by the end of 2022? How have you been trading this year? And the point that we want to make is that your trading rules need to be consistent no matter what market regime that we are in. Obviously, the trades are going to look differently, but we need a repeatable, defined process so that we're not governed just by our emotions. Alex, why don't you tell us a little bit about a repeatable process and a checklist for your teenage son?
Yeah, so scarily enough, he's learning to drive. Who'd have thought you'd have a kid that old? But there you go. But one of the things you want to ensure is that they are as safe as possible when learning to drive or getting behind the wheel. And if you could make sure that they follow a certain checklist or a reminder of things that they must do every single time they sit down behind the wheel, you're going to have a better chance of ensuring their safety. For example, you have to put on your seatbelt. You want to make sure that you check your mirrors. You want to make sure that you signal before you pull out into oncoming traffic. And finally, you would engage the gear and drive off. And if you do those few things every single time, you aren't so likely to pull into oncoming traffic. You aren't so likely to be taking risks that you don't want to take when doing something like that. And it's exactly the same for technical analysis. When understanding technical analysis, you need to follow a process that allows you to make decisions within an intelligent framework. And you can use anything to do that. You could be using Dow theory, trend lines, moving averages, different pattern analysis, confirmation, or even relative strength. But whatever you're using, you're doing it so that you stack the weight of the evidence in your on your side, and you put the odds in your favor. And if you do that, then you can really, hopefully, start to manage your investments in a more responsible way.
Now, when we talk about trend identification, right, the rules for entry and exit, let's just start with the very basic of looking at a bar chart. Now, we can eyeball a price chart of any security, and if you can identify that there's a general movement, say from lower left to upper right, what you're doing is you're spotting a series of higher highs and higher lows. That's the definition of an uptrend. Now, the problem with this is that it only works in hindsight, right? You're only going to be able to identify a trend after it's already begun. And of course, it's very subjective. Not every chart has a very clear delineated line. It's also going to depend on your time period. Now, if we wanted to be more objective about identifying these trends, because arguably that's the most important job we have as technical analysts, we want to be able to participate in the meat of the move, meaning we want to identify our entries early enough. We want to identify our exits before we have given back too much of those gains. So if we wanted to be objective about that, let's go through a few technical indicators that we could use. Alex, why don't you talk to us a little bit about Donchian channels or price channels?
I mean, that's the whole goal, right? Is to be able to take the subjectivity out of the process and know that what you're actually seeing is fact. And when we do that, we turn to these calculated indicators rather than just using our eyes to see what we think we're seeing on a chart. So if you are familiar with the story of the Turtle Traders, phenomenal story about Richard Dennis, who believed that it was possible to teach people to trade, just like he'd seen people grow turtles in his travels around the world. He thought you could grow traders by giving them sets of rules to follow. And their main entry and exit was based on Donchian channels. And with these channels, all you're doing is you're looking back at a period and you are evaluating whether or not current price is the highest price of the period. And if it is, you'll move that line up. So the green line here on the chart is showing all of the period highs for price. And as you make a new period high, that green line will move higher. And if you continue to make higher highs, the line will move higher and you'll be able to see that high moving with price. And the same thing on the lower end is the lows. If you can see that red line moving higher, you know that the lowest price over the period is moving higher as you see price move higher. So in the sort of the left middle of the chart, you can see where that green line starts to move higher. That's when we're making new higher highs based on the look back period of the indicator.
Now, of course, we were able to spend a few days with our good friend Jerry Parker at the CMT Association 50th Anniversary Symposium. And one of the things that really stood out to me about his presentation was that there are a lot of the rules that he started working with Richard Dennis on many decades ago, and they're still a part of his trend following investment practice. It doesn't necessarily change so much over time. And so that was a really great takeaway. Now, perhaps the most widely used technical indicator, and one that you and your colleagues at Bloomberg back in the day didn't even consider technical analysis, right? As portfolio managers who said they were strictly fundamental in their investment, still used moving averages on their charts just to identify that the price was moving in a way that was higher than its historical average. Paul Tudor Jones says that everything he looks at has to beat the sniff test, if you will, for the 200-day moving average of closing prices. What we're looking at here is a very simple indicator, but as a trend following indicator, it's lagging. So it's a look back period, and we're just looking at the average of prices. So it's inherently bullish when price action is above its moving average. But of course, Alex, lots of traders would say, well, one moving average is good. What about 3 or 4 or 5, right?
Yeah, when you do this, you smooth out the price movements, but you still get that sense of trend change. And what we look for then is the crossovers between two moving averages. So we look at the interplay between a shorter moving average and a longer moving average, and we can really start to see when those trends change. If the shorter term average crosses above the longer term average, then we're saying that in the short term, investors are more enthusiastic and price is moving quicker than it did in the longer term. And now that's a big difference from just using one, because price can fluctuate around a moving average and give you a lot of sort of whipsaws when you're trying to see whether or not price is indeed higher than its moving average.
Now, the next one we could look at comes from another CMT charter holder and a friend, John Bollinger, who identified Bollinger Bands in the early 1980s. And so if you go back to your early math classes, you know that 2 standard deviations away from a mean for a normally distributed data series, it's going to encompass about 95% of all of the data. Now, we know financial markets are not evenly distributed, but we know that it is a very significant fact or a significant activity when price is moving, extending to the extremes of those 2 standard deviations or even outside of the Bollinger Bands. Now, there's a couple different ways of using Bollinger Bands, but one of the things that John has taught us is that when bands are narrow, when you have compressed volatility, it's going to precede expanding volatility. So what we want to identify then is the direction of the break. When price is breaking to the upside from a relatively narrow set of bands, we know that is inherently bullish and could be the identification of the start of a trend. But we don't stop right there. Let's talk a little bit about confirmatory indicators, Alex.
Yeah, Charles Dow talked about this way back when, that volume is not as important as price, but it certainly can give you a sense of market participation. And so it's sort of the first confirmatory indicator that we might put on a chart. When we see something happen in price, we want to understand whether or not the market is participating in that move, or whether it's just a few traders moving price action. So we'll want to see relatively healthy volume when we see a new trend take place. So volume is certainly something that you'd add to your checklist to get a sense of whether or not this move was healthy or not.
And then, of course, we could go on and on. Let's just do one more. The moving average convergence divergence from Gerald Appel, another friend of the CMT Association and an annual award winner at our conference a few years ago. What this is doing is blending some concepts of momentum and trend. But what we're looking for is the MACD to cross above its signal line or below its signal line, giving us cause for some risk management. Now, we could add endless tools to this chart, right? This is a fairly simplified process. It's responsible in its approach. We're looking at multiple constructed indicators to give us that weight of the evidence. But as we add moving averages and price channels and Bollinger Bands and volume and MACD, we're starting to see some clutter, right? We could identify that somewhere in this blue oval, there's enough weight of the evidence to suggest that we have begun a new uptrend. but that's capturing almost a month worth of trade activity. And so what we're concerned with here is the interpretation, the subjectivity that technical analysis introduces as we have more and more on our chart. Now, a lot of these indicators are just going to be redundant, but some of them are even going to be contradictory at times. And so it's up to the individual trader then to decide, do I want confirmation from my complete set of indicators? Do I need full consensus? Am I waiting that long to enter? What about periods where the market is a bit uncertain? And when we have this much on our chart, we reintroduce a lot of those emotional biases that we're trying to get away from, trying to be more objective in our approach as technical analysts. So that gives us our problem, right? Analysis paralysis, the reintroduction of a lot of those behavioral biases by adding too much to our chart. Now, I don't want anybody to take away the wrong message. We, Alex and I, are extremely indebted and forever grateful to the men and women of Wall Street who innovated, who observed, and who invented these tools that we now have at our disposal. All of those amazing indicators on your TradingView chart, they are all powerful, and we want all of that information, but we want it computed on the back end. We don't want the analysis paralysis on our chart. We don't want the indicator overload. We just want the information. So Alex, talk to us a little bit about the solution, GoNoGo Trend.
We wanted to capture all of that information that we believe adds value to a chart. And this is, of course, based on, between the two of us, way too much time in the industry talking to institutional investors and institutional clients and trying to put together a process that we believe is the best for identifying trend. But we want to do it in the background. So we take all of those components, the foundational concepts, the statistical measures of trend identification that we look at, and we blend them together behind the scenes to just leave us with an indicator that color codes price according to the strength of its trend. So that's what the GoNoGo trend does. It takes that information and tells us what the trend is, how strong it is it weakening, whether it's an uptrend or a downtrend, but it keeps the chart simple, allowing us to make decisions and to do technical analysis while looking at a chart that's not crowded. We hope it's elegant, and we know that it's informative to do it in this way.
And so most importantly, our best indicator of all is price action itself. Price is the first and foremost indicator in all technical analysis. So when we remove a lot of the data visualization, the troubled chart that we saw a moment ago, but keep all of that weight of the evidence in the background, we can spot areas of support and resistance, key price levels that once we break through an area of resistance, we know that can become support. It's inherently bullish. We want to be able to pay attention to that price action because after all, it is price that pays. So a quick review. Within a GoNoGo chart, you have two colors for Go trends. The bullish environment is articulated by these blue, the strong form Go trend, and these aqua bars, a weaker form. We built some sensitivity into the model. Similarly, for downtrends, we have no-go conditions, purple being the strong form of a bearish environment and pink being the weaker form of a bearish environment. You will also notice at these moments of transition, neutral bars. And Alex and I are deep fans and forever grateful for the life and works of Jesse Livermore, who's famously quoted as saying, in markets, there is a time to go long, a time to go short, and a time to just go fishing. When the weight of the evidence, when the message of the market is so unclear and uncertain, in all of our background indicators are in their neutral territory. So we have go bars, no go bars, and go fish bars in this momentum model. So we're so proud of this work that we have given it away for free. All that we would ask is that you let us know how it's working. So right on TradingView, you can apply this free indicator, GoNoGo Trend, to any of your charts. Just let us know how it's working. What securities are you trading? What time frame are you using? Has it changed your decision-making matrix? And you can send us that info at GoNoGoCharts.com. Let us know how that's working out for you. Thank you to all of you on TradingView for paying attention to this first educational installment from GoNoGo Charts. Again, if you have any questions or some feedback for us, you can reach us at info@GoNoGoCharts.com. And until next time, take care of each other and trade them well.